Hello, my name is Greg Cesario, and welcome back to week 20 of the weekly JobCommander edition of Veterans Corner. I proudly served in the U.S. Army during Vietnam from 1967 to 1969. For this session, the focus will be on my take for the 2026 economic outlook and how it may impact veterans and their job search. It will be loosely compiled using my economics degree and an accumulated financial perspective based in reality after 2 deep recessions, the COVID lockdown, and 2 revolutions in technology in 50-plus years. First, some qualifiers. No significant geopolitical event, the Federal Reserve continues its accommodative posture and the housing market begins a gradual recovery, moderately rising home prices, and a drop in elevated mortgage loan rates. Overall, based on what I've seen, in 2025 is a highly resilient year, especially for the consumer, and the economy is highly growth-oriented, including GDP, employment, and financial markets. The lag of small and medium businesses, SMB, enterprises, will likely enjoy a surge. That is not to say that the large corporate enterprises will suffer in 2026, but it appears growth opportunity leadership roles will juxtapose in favor of small-medium businesses. If that's accurate, that shift favors job opportunities and placements for most veterans, especially for those who wish to extend or seek a trade career. The entrepreneur portion, along with much of the overall economy, will likely flourish due to the broad regulation reduction across the economic landscape compared to 2025 and earlier. Prior economic expansion consequences experienced in 2025 were caused mostly by a failure of excessive monetary stimulus policy, thinly veiled as a cure for the COVID shutdown. In contrast, the major changes to the economy started in 2025 and will mature in 26 and 27. What the difference stimulative monetary policy versus economic policy? One is driven purely by the money supply and interest rates versus the other drives productivity, growth, and keeping more of your earned income, therefore improving purchasing power and higher real wages. For the first time in a great while, the third quarter GDP grew at a staggering 4.1%, in spite of a 45-day shutdown headwind. The labor participation rate is rising out of its lethargic low 60% range. A short time ago, there was a $7 to $8 trillion sloshing around in money market funds. That money seems to be going to work as investments and the stock market versus collecting high interest static yields. Those lower yields drive money managers and investors toward better returns elsewhere. They go where the ducks are. Get ready. It's going to be a wonderful economic ride, and you can be part of it. What's your post-military career reinvention wallet? Stay motivated, and I'll see you next week.